The Sensex, India's benchmark stock market index, was born in 1986. It started as a humble indicator of the Bombay Stock Exchange, or BSE. With just 30 of the most valuable companies, it reflected the pulse of corporate India. In April 1990, the Sensex crossed the 1,000-point mark. This milestone marked a turning point. It signaled the emergence of a new era for the Indian economy. The journey from its inception to this first milestone was significant. India was then a closed economy. It had strict regulations and limited foreign investment. The crossing of the 1,000-point mark was a sign of change. It indicated growing investor confidence in the Indian market. The early investors in the Sensex were primarily domestic players. These included financial institutions, banks, and individual investors. Their participation reflected a growing belief in India's economic potential. The 1990s marked a turning point for the Indian economy. The 1991 economic reforms in India marked a paradigm shift. The country embraced liberalization, privatization, and globalization. This led to increased foreign investment and participation in the Indian stock market. The Sensex witnessed a surge reflecting positive sentiment. FIIs became major players, bringing in capital and expertise. It fueled growth in technology, pharmaceuticals, and financial services. Companies like Infosys and Wipro emerged as global players. The disinvestment program boosted the market. The late 1990s witnessed a global technology boom. The rise of the internet and the dot-com bubble had a profound impact on stock markets worldwide. India, with its growing pool of skilled engineers and software professionals, became a key player in the global IT outsourcing market. This led to a surge in the valuation of Indian IT companies, propelling the Sensex to new heights. The growth of the IT sector had a ripple effect on the Indian economy. It created numerous jobs, boosted exports, and attracted foreign investment. The success of Indian IT companies on the global stage enhanced India's image as a rising economic power. This positive sentiment further fueled the growth of the Sensex. However, the tech boom was not without its challenges. The dot-com bubble eventually burst in the early 2000s. This led to a sharp correction in global stock markets, including the Sensex. Despite the correction, the Indian economy showed resilience. The global financial crisis of 2008 sent shockwaves through the world economy. Stock markets crashed and investors panicked. The Sensex also witnessed a sharp decline, reflecting the global uncertainty and fear. However, the Indian economy proved to be more resilient than many had anticipated. Several factors contributed to India's resilience. The country's strong domestic demand, robust banking system, and prudent regulatory measures helped cushion the impact of the global recession. The government's stimulus packages and the Reserve Bank of India's, or RBI's, monetary policy measures also played a crucial role in stabilizing the economy and the stock market. The Sensex, after an initial sharp decline, gradually recovered. It reflected the underlying strength of the Indian economy. While developed economies struggled to recover from the recession, India emerged as one of the fastest-growing major economies in the world. This resilience boosted investor confidence, attracting foreign capital and further fueling the growth of the Sensex. Section 5. The Modi Effect and Market Momentum. The election of Narendra Modi as Prime Minister in 2014 brought renewed optimism to the Indian economy. His pro-business policies, focus on infrastructure development, and initiatives like Make in India aim to attract foreign investment and boost economic growth. The stock market responded positively to Modi's victory. The Sensex surged to new highs, reflecting the positive sentiment among investors. Modi's government implemented several key reforms, such as the Goods and Services Tax, or GST, and the Insolvency and Bankruptcy Code, known as IBC. These reforms aim to simplify the tax structure, improve ease of doing business, and address the issue of non-performing assets in the banking sector. These reforms were generally well received by the market. They were seen as steps towards creating a more stable and predictable business environment. The government's focus on financial inclusion through initiatives like the Jan Dhan Yojana also had a positive impact. By bringing millions of people into the formal banking system, these initiatives expanded the reach of financial services. This, in turn, created new markets and opportunities for businesses. Investor sentiment plays a crucial role in driving stock market movements. Positive sentiment can lead to increased investment, while negative sentiment can lead to a sell-off. Several factors influence investor sentiment, including economic growth, corporate earnings, interest rates, inflation, and government policies. In the case of India, investor sentiment has been largely positive in recent years. The country's strong economic growth, favorable demographics, and pro-reform government have attracted significant foreign investment. Foreign institutional investors, or FIIs, have been pouring money into the Indian stock market, drawn by the long-term growth potential of the Indian economy. Domestic institutional investors, or DIIs, which include mutual funds, insurance companies, and pension funds, have also played a key role in supporting the market. DIIs have been increasing their equity exposure in recent years, reflecting their growing confidence in the Indian economy. The Sensex's journey from 1,000 to 76,000 points has been marked by several significant milestones. Each milestone reflected key events, policy changes, and investor sentiments. For instance, the crossing of the 10,000-point mark in 2005 signaled India's emergence as a global economic powerhouse. The 20,000-point milestone, achieved in 2007, demonstrated the growing influence of foreign institutional investors in the Indian market. The 30,000-point mark, crossed in 2010, reflected the resilience of the Indian economy in the aftermath of the global financial crisis. The Sensex continued its upward trajectory, crossing 40,000 points in 2017, 50,000 points in 2020, and 60,000 points in 2021. These milestones highlighted the sustained growth of the Indian economy, driven by factors such as strong corporate earnings, favorable government policies, and robust domestic demand. The Sensex crossing the historic 76,000-point mark is a testament to India's remarkable economic journey. It signifies the country's transformation from a closed economy to a global economic powerhouse. This achievement is a reflection of the collective efforts of policymakers, businesses, and investors over the past few decades. The 76,000-point milestone is not just a number. It represents the aspirations and growing prosperity of millions of Indians. It signifies the increasing participation of retail investors in the stock market. It is a symbol of their confidence in the country's economic future. The Indian economy is expected to continue its growth trajectory in the coming years. Factors such as a young and growing population, increasing urbanization, rising disposable incomes, and government initiatives like Digital India are expected to drive economic growth. This positive outlook for the Indian economy bodes well for the stock market. However, there are also challenges and risks that could impact the market's trajectory. Global economic uncertainty, geopolitical tensions, and domestic factors such as inflation, interest rates, and government policies could all influence investor sentiment. Despite these challenges, India's long-term growth story remains intact. The Sensex is likely to continue its upward trajectory, although it might experience periods of volatility along the way.